You might think that Warren Buffett, the world's most famous value investor, spends his days worrying about stock market valuations and trying to time the perfect moment to invest in stocks. But let me tell you, after you watch this video and subscribe to the channel, you'll learn that Buffett's approach is far more straightforward and focused. First off, Warren Buffett focuses on individual stocks rather than the broader market. During a Q&A session, someone asked him about the rising valuations in the Nasdaq market, where companies are trading at sky-high multiples of their revenues instead of traditional price-to-earnings ratios. Buffett's response? Well, he doesn't care. You see, throughout his and Charlie Munger's investing careers, they've seen it all. Overpriced stocks, phony promotions, and gullible investors getting led astray. It's just par for the course. What really matters to them is finding those wonderful businesses, not trying to predict where the market is heading. Buffett's attitude is clear. They're not in the business of market timing. They're in the business of finding solid companies that stand the test of time. So, when it comes to stock market trends, they simply don't pay it much mind. Instead, they focus on what truly counts, the businesses themselves. Now, let's talk business. Berkshire Hathaway is known for its strong portfolio of international companies like Coca-Cola and Gillette. But have they ever considered looking beyond their borders for undervalued foreign companies? Absolutely. They've explored companies headquartered in other countries, and they continue to keep an eye out for opportunities wherever they may arise. Whether it's in the US, England, or anywhere else, if a company fits their criteria, they're open to it. Buffett believes that what truly matters is the quality of the business, not where it's headquartered. While they do have a deeper familiarity with domestic companies, even if they operate globally, they don't let a company's domicile limit our thinking. They may feel slightly more at ease when they understand the tax, political, and governance nuances of a domestic company due to the daily engagement with such matters. However, Warren's enthusiasm for discovering exceptional businesses knows no borders. Berkshire Hathaway is open to finding outstanding businesses domiciled in any of the world's many countries. It's true that they may not scrutinize foreign companies as rigorously as domestic ones, but that doesn't mean they won't consider them. The investing company has reviewed numerous annual reports from companies around the globe and have even invested in a few. Admittedly, these foreign companies tend to be smaller, which can pose challenges in terms of the capital required. Nevertheless, they're always on the lookout for promising opportunities, regardless of where they may be located. They look for companies with a market capitalization of at least $5 billion or more that align with our investment criteria and are attractively priced. When such an opportunity arises, they're ready to make a purchase. Buffett's investor company has grown in prominence, and the recent Class B offering may attract a broader range of investors. As for the 50 million shares of Class B common stock that may be offered, it's important to clarify that this is a precautionary measure due to the conversion of Class A shares to Class B shares. They understand that their popularity extends beyond their core investor base. Still, they believe in providing transparency and making their shares accessible to those who are genuinely interested in being part of the Berkshire Hathaway family. They're mindful of maintaining our core values and principles, even as they adapt to changes in investor profile. And if that sounds like a good approach to you, make sure to like this video and subscribe to the channel for more content like this. Warren Buffett has specific reasons behind authorizing 50 million shares. This number is essential to accommodate the potential conversion of Class A shares to Class B shares, a precautionary measure for the unlikely scenario in which every shareholder decides to make such a conversion. Concerns about history repeating itself, particularly in the context of the unit trust, are shared by Buffett and Berkshire Hathaway. They've proactively taken steps to avoid a recurrence of past situations where their popularity led to unforeseen consequences. Their goal is to safeguard shareholders' interests and preserve the company's integrity. It's intriguing to consider how their position might have evolved had history taken a different course. Buffett acknowledges the disillusionment that can occur when expectations aren't met, hence their efforts to filter out people with unrealistic beliefs. They emphasize the importance of thoroughly reading the prospectus before making share purchases, believing they've effectively crafted their approach to address this issue. Regarding high-tech stocks like Microsoft, Pfizer, and Johnson & Johnson, Buffett's consistent stance is to invest in businesses they deeply understand. While they respect these companies and the opportunities they offer, their expertise lies in industries where they possess profound knowledge. This approach aligns with their principles of prudence and the protection of shareholders' interests. When evaluating companies such as Coca-Cola, Johnson & Johnson, and Pfizer, they consider compelling factors. These companies have demonstrated strong management spanning 10 to 15 years and dominant market share positions that are challenging for competitors to breach. Notably, when comparing their price-to-earnings or PE ratios, there isn't a significant difference observed when compared to Coca-Cola. Their investment philosophy places a strong emphasis on a profound understanding of the businesses they invest in. If the intricacies of an industry aren't clear to them, they tend to steer clear. This approach has proven successful over the years. While they acknowledge the potential in companies like Microsoft, they remain cautious about confidently predicting the technological landscape in 10 or 20 years. Let's look at Gillette as a prime example. Shaving technology continually advances, and Gillette consistently invests significant resources in developing superior shaving systems. Buffett's robust distribution network and consumer trust, particularly with the shaving industry, are invaluable assets that are challenging to replicate or dismantle. Their focus remains on industries where they can reasonably forecast the future, with technology-intensive sectors posing greater uncertainty. When considering who to trust with navigating the complexities of an ever-changing business environment, Bill Gates might be a top choice, given his exceptional leadership and adaptability. But their preference is not to bet on people. Their fundamental approach revolves around gaining a comprehensive understanding of the businesses they invest in. While the financial world often highlights industries with significant potential for change as fantastic opportunities, they maintain a different perspective. When an industry stands on the brink of transformation, it evokes a sense of caution. This is because they lack confidence in predicting how these changes will unfold. Instead, they gravitate towards investing in sectors where they possess a clear understanding of business operations and potential evolution. For instance, consider chewing gum. People have been chewing gum for decades, and we can reasonably predict how they'll chew it in the future without needing to rely on groundbreaking technology. So why venture into sectors where we lack expertise and insight when we can invest in simpler, more predictable businesses? Through this remarkable journey, Buffett has shown us that successful investing isn't about trying to predict the unpredictable or chasing after the latest market trends. Instead, it's about staying true to a set of timeless principles that prioritize a deep understanding of the businesses you invest in. Market fluctuations, while important, should not be the sole driver of investment decisions. Buffett's unwavering focus on individual businesses rather than broader market movements is a testament to the power of long-term perspective. He understands that markets can be erratic and sentiment-driven in the short term, but a well-chosen business can weather these storms and deliver substantial returns over time. So, whether you're a seasoned investor or just starting your journey, remember the lessons of Warren Buffett. Focus on the business, not just the stock price, and invest with patience, prudence, and a commitment to lifelong learning. By doing so, you'll be better equipped to navigate the ever-changing landscape of the stock market and build lasting wealth. And make sure to like and subscribe to the channel for more videos like these.